Forget about all of the noise. It's the best performing asset in all recorded history. Right? It does 140% a year returns, and that's including 3 or 4 80% drawdowns. Right? No asset has ever existed like this before. It's a fucking gift. When we needed it the most, we've been given a gift from the gods. Much like AI was a gift from the gods. We've been given something that can unfuck your future, which is the whole thesis that I've been talking about. So do that. And so it's not about liking, it's not about the culty thing, it's not about any of it. It's like, if I've got 6 years and I want to make as much money as possible, I want to own the best risk-adjusted reward asset I can. And technology is the second one, somewhere in the middle of summer. So the weather's good, it's easy to make money. And this is the acceleration that happens around the US election years, and this has happened every time, is what I refer to as the banana zone, where everything goes bananas. And in crypto terms, the charts just look like bananas standing on end because they just go vertical. Because
Pal begins by explaining the concept of macro summer, which refers to a period when the economy starts firing up again after a slowdown. In this phase, inflation is usually subdued and growth accelerates across various markets. It's during these periods that virtually everything goes up: commodities, small-cap stocks, tech, and crypto. According to Pal, we are currently in this macro summer, and historically, this phase tends to accelerate around U.S. election cycles. The performance of most markets, particularly tech and crypto, is typically strong leading up to and following U.S. elections. One of Pal's more colorful metaphors is the banana zone, a period where markets, particularly crypto, experience exponential gains. He describes the charts in this zone as looking like bananas standing on end, symbolizing how vertical price movements can become. This kind of market environment, especially around U.S. election cycles, is driven by liquidity injections from central banks and government policies.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
macro summer's when the economic machine starts firing up again. And that lends to another acceleration in markets and growth, whilst inflation tends to be falling or subdued. And that's a really lovely period because you can make money in pretty much everything. Commodities go up, gold goes up, small caps go up, crypto goes up, tech goes up, everything goes up. And that's where we are now. And so that summer period, the real footprint usually accelerates around the US election and after it. And that's when most markets have their best performance. So there is a seasonality around elections, which you tend to get strong first half of the year or first part of the year. Then it tends to be a bit more sideways, which we had in tech and we had in crypto, and where the rest of the market started playing a bit of catch up. And then you get the acceleration that goes on for the end of summer straight into macro fall, which is 2025, when really the best gains come of all. So that's where we are. So back then we were just starting. Now what happened? Crypto went on a massive tear, then had that sideways consolidation. Tech had a massive tear, had a sideways consolidation. The rest of the market's now catching up. And the next phase is the money shot. We're still in summer. So basically, if you think late summer, the weather's pretty good. That's where we are. Somewhere in the middle of summer. So the weather's good. It's easy to make money. And this is the acceleration that happens around the US election years. And this has happened every time, is what I refer to as the banana zone, where everything goes bananas. And in crypto terms, the charts just look like bananas standing on end because they just go vertical. Because around the election period and the year afterwards, they all have to refinance, $10 trillion of debt. The Fed has not been able to the Treasury's not been able to refinance easily. So it's been issuing short end bills, which is basically a holding pattern for rates to come down. Wait for rates to come down And then you can refinance your rates. It's like you don't want to refinance your mortgage at highs. You want to refinance your mortgage at lows. So you keep your money in a money market fund, which is basically what the Fed did, and then they'll do that. So that period of massive liquidity tends to debase currency. We're seeing China coming out with the cowbell, more stimulus. The US has started the rate cut cycle. That's going to come down a lot. The EU have started. The UK have started. Everybody started. And so the big game is at play. Forget about all of the noise. It's the best performing asset in all recorded history. Mm-hmm. Right? It does 140% a year returns, and that's including 3 or 4 80% drawdowns. Right? No asset has ever existed like this before. It's a fucking gift. When we needed it the most, we've been given a gift from the gods. Much like AI was a gift from the gods. We've been given something that can unfuck your future, which is the whole thesis that I've been talking about. Mm-hmm. So do that. And so it's not about liking, it's not about the culty thing, it's not about any of it. It's like, if I've got 6 years and I want to make as much money as possible, I want to own the best risk-adjusted reward asset I can. And technology is the second one. Liquidity really comes from central banks and governments putting money into the system. So we have something in the US called Fed net liquidity. So what is the 3 component parts of that state level liquidity? Well, that's driven by the Fed balance sheet, quantitative easing. They're still tightening, but they've reduced the amount of tightening. Then we have the reverse repo. And that is basically where banks mop up all of their funds. So if that's very big, money's tight. And when they start taking the money out, it goes into the banking system. The other side is the Treasury General account, which is the checking account of the government. Now, if they've got a lot of savings and they're not spending it, which is where we are today, then conditions are tight. But once they start writing checks, what happens is that money floods into the system. And that is a kind of a net increase in money into the system. So if you make more of something and it's in abundance, its purchasing power or its value declines. So it's not that necessarily you and I get to borrow money more easily. It's not that. It's that there's more money around and it debases currency. It's like this magical thing that happens. Now, on the private sector side, the stuff like M2 growth and private sector credit growth is kind of a function of that, but they both work together because you can create dollars in a Eurodollar system. You can just create them out of thin air by being a bank. And so what happens is there is this huge increase in money that happens. But we as people don't generally get it. Sure, your mortgage rate may fall a bit, but really it's this debasement effect that happens that's more insidious that we don't see and don't really understand. Asset prices take off, but our earnings don't. So therefore, we get poorer in terms of the assets we can buy. And an asset is just future deferred consumption. If you buy gold today, your expectation is you can sell it in the future at a higher price to protect your purchasing power. But today, you can buy less gold than you could a month ago, and less gold than you could 5 years ago, and because your wages don't go up in the same as these scarce assets that move because of debasement.
One of the key points Pal makes is the critical role that the Federal Reserve plays in preventing financial catastrophe. He notes that the Fed has implemented what many refer to as a Fed put, where they intervene in the market to prevent significant declines in asset prices. In 2022, when the S&P 500 dropped by 30%, liquidity injections stopped it from falling further. Pal explains that the Fed does this because the entire financial system is built on collateral, and much of that collateral is tied to equity markets. If equity markets collapse, it would unravel the collateral system, which underpins everything from bank loans to pensions. The Fed's actions effectively remove much of the risk from the system, creating what Pal calls the everything code, a macroeconomic environment where the biggest risks are mitigated, allowing for unprecedented risk-taking opportunities.
Right, what they're actually doing is devaluing the purchasing power of money by 8% a year, which is the increasing global liquidity. But most people don't understand it. And so what happens is you have a savings account, you think you're doing all the right things, and suddenly you still can't buy a house. And you still don't buy much, you can't buy as many shares of Tesla as you wanted to, and you still can't buy as much gold as you wanted to. And you're like, why? I'm saving money, I'm working hard, but I can never get up the ladder. That's what debasement's about. Of all the assets that we monitor at Exponential Asset Management, there are only 2 that beat the 8% debasement plus, let's say, 2 or 3% global inflation. So 11% is the hurdle. The S&P keeps track of it roughly. The NASDAQ does 17% a year return since 2011, and Bitcoin does 140. Gold doesn't meet it. Almost nothing else meets it. So you're really herded into 2 assets only that can actually beat this thing and make you money, so your future self gets wealthier. So people have been incentivized to do that. Now, you might say, but this is crazy because people are taking such risk. But there's another piece of magic that happened, is the Federal Reserve and the government understand that this is the case, and they understand that we have a lot of debt, and we understand that the collateral of the debt is the savings and investments of the population, so they don't allow it to go down much. So if you saw it last time, the S&P got down 30% in 2022, and liquidity came back. So they've stopped markets falling 50, 60, 70%. Sure, different stocks can, crypto, because it's not really a big part of the collateral system, but they don't allow the collateral to fall. So what they've done, what it means for all of us, is they've taken the big risk out. Listen, if you've got a lot of debt, your collateral is what you pledge against the debt, right? The whole system is built on this. That's what blew up in 2008, because the house prices went down and everyone's loans were this high. But if you think of the whole system, all the banks and all the asset management firms and all the leverage and all the private equity and all of the stuff, they don't want the equity to go down, because that's the collateral. They allowed the bond market to go down because in the end it gets repaid. So it's a mark-to-market loss. But in equities, when you've got this massive retirement system, you just don't want that. So this Fed put is part of the everything code, where they've just stopped that event. So they debase currency to erode the debt, make the interest payments, because if not, they'd never be able to pay the interest, because you'd eat up all of GDP growth just to pay this interest, because it's 100% of GDP. And they stop the big bad event. So what that gives you is the greatest macro risk-taking opportunity of all time. Doesn't mean the business cycle's gone, but overall, you've got the best risk-taking cycle in history.
Raoul Pal lays out a compelling case for why we are entering one of the most favorable macroeconomic environments for investors. As central banks worldwide ease monetary policies and liquidity floods the system, we are poised to enter the money shot phase, a period where markets accelerate and everything from tech to crypto stands to gain. However, this environment also comes with its challenges, particularly currency debasement, which erodes purchasing power. For those looking to not only survive but thrive, Pal suggests focusing on assets like Bitcoin and the S&P 500, which have historically outperformed this debasement trend. As we approach the U.S. election cycle and the global liquidity tide rises, Pal's message is clear. This is the greatest macro risk-taking opportunity in history, and those who understand the dynamics at play stand to benefit immensely. Now is the time to position yourself for the acceleration ahead.
Please like and subscribe my channel.